Let's go! Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, good morning. My name is Wayne McDonald. Welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis. And how about retail sales? How about news out of Canada? Yeah, we're going to do all that. However, trading is risky, not appropriate for everyone. Past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. And we're only 5 minutes away. 5 minutes away from Canadian CPI and U.S. retail sales. Ooh la la. Hey, it didn't reload. It did reload, it just didn't play. U.S. dollar soft and trading broadly lower versus most G10, Scotiabank. Canadian dollar up marginally into CPI, Scotiabank.
The U.S. dollar is lower to start the U.S. session, with declines versus the euro and Swiss franc leading.
Canada, August housing starts 245.8K versus 277.5K expected.
Canada housing starts SA year over year came in at 245.8K, below expectations, 277.5K in August. Crypto today, Bitcoin, Ethereum, XRP offer recovery signs as stablecoin inflows surge.
Pi Network price forecast. PI remains steady at 0.35 as market awaits Fed rate decision.
Commerzbank raises end-year gold price target ahead of key Fed rate decision.
Yay!
S&P 100 drifts lower for third straight session.
US dollar index, DXY, dives below CT7 5 zeros as investors brace for the Fed.
Yeah, baby, yeah. So anyways, Canada, we're going to what? A low CPI or something, and that'll allow the Bank of Canada to cut interest rates. Okay. Retail sales, well, it can be choppy. We also want to look at some of the subcomponents, but the bottom line is, the Fed's going to do their move tomorrow. It's like, how afraid are they going to be under this new labor market that we have? That's going to be tomorrow's big thing. And will they move the neutral rate lower and say, you know what, we understand CPI is getting close to 3, but maybe they're okay with that. Yeah, which means, well, maybe they can take rates lower than they normally would. I don't think they're going to do 50, and I don't think they're going to do 3 cuts this year, but will they keep cutting? Will they go one tomorrow, one in December, one in March, one in June, and then hold? I don't know. So we're going to have to figure that out for tomorrow. Let's just eyeball as we go into retail sales. Yeah, I don't think any of these numbers for retail sales are going to dramatically change any Fed policy. Yep. But maybe some control group analysis helps us point out to PCE and all that kind of stuff. I don't know, maybe. But right now the average is 0.28 going back over a year. What are we expecting? 2? Well, that would be below average. You guys excited? Yeah, WTI. Yeah, I saw that. We've been at resistance a very long time. So again, I think retail sales control group will then filter towards PCE, which isn't for a while, not until after the Fed meeting, but then could lead to maybe more cuts than what's priced in, maybe. But I think really it's the tone of tomorrow's FOMC that really is going to set that. So we'll just see what's going on. We got to be here. It's our job. 3, 2, 1. Don't forget about Canada. 3 on Canada. And, ooh, it's hot. Oh, retail sales is hot. Huh? There's the control group. That's hot. There you go. So that's kind of the subcomponent that I'm looking at. Last time it was 5. And we thought, or the market thought 4, but it came out 7. So that puts us, let's see, if I follow my train of thought here, that could possibly lead to a higher PCE in 10 days or whenever it is. And holy smokes, that's inflationary. Okay, our average is 2.8, and we pulled a 6 today. Wait, what? A 6? Yeah. Yeah.
Canada
right.
Bank of Canada. Consumer Price Index Core, MOM, fell from previous 0.1% to 0% in August. United States Export Price Index, MOM, registered at 0.3% above expectations, 0%, in August.
WTI price forecast. Oil steadies near 63.50 with bullish bias.
Euro is outperforming on ZW surprise, Scotiabank. Bay Street likely to open. On mixed note, Canadian inflation data in focus.
Yeah, so all that just came out, and then pretty soon we're going to get headlines on all this other stuff. But eyeballing our retail sales. Yeah. Search is so stupid now, isn't it? There we go. All right. So where does this live? Let's where are the numbers coming from? General merchandise. Yeah. It's down, but cars, yeah, durables, yeah, it's pretty high. Oh, and look at last month was revised up. That's a pretty hot number, guys. That's a pretty hot number. And what does it say about the control group? No, this report doesn't really show much. Huh? Anyways, doesn't really say anything different. But so now our revision is up too. Wow. That's two. Like, think about it. And this is why we have this data, right? So if we go back a year and our average is 2.8, and we just pulled, 0.28. So let's just call it 3.3. For the last year, we've been averaging 3. We just pulled a 6, and then last month was revised up to 6. Right? Yeah, short-term rates, yeah, all of that is priced in, right? One way of looking at it is Fed funds rate, right? So when you ask, is it already priced in? Well, this is what this means. It's not a survey of like, what are you going to do tomorrow? All this stuff is what people have already done. That's where the term pricing in comes from. They've quite literally paid a price, negotiated a price. That's the price right there. So this is people pricing stuff in. There's a rate cut coming. Okay, a month ago, they had already priced it in. Yeah. So that's where you'd expect to see, if you're going to take that further on the yield curve, you're going to see that over here on the 10-year. Okay, Sky Killer. And you would see this yield falling. So the fact like the yield on the 10-year dropped to 4.3 yesterday indicates that people are actively pricing in. And in fact, this used to be 4.5. It used to be 5, but let's say, around June, this was probably 4.5. So now it's 4. What's happened? People are putting money into the 10-year T-note because they believe a 10-year T-note 6 months ago that pays 4.5 will be paying more than later in the year because they believe the Fed will cut. When the Fed cuts the Fed funds rate, then the discount window comes down. The prime rate comes down. Mortgage rates come down. Treasury yields come down. They're all interconnected.
US retail sales rise 0.6% in August versus 0.2% forecast.
Indonesia, FX. Today, the rupiah awaits confirmation of Bank Indonesia's cautious approach. 2 AI tokens to watch as Ethereum Foundation debuts new AI team. U.S. retail sales rise 0.6% in August versus 0.2% expected. Breaking, Canada headline CPI rose 1.9% year over year in August. United States retail sales, MOM, above expectations, 0.2%. In August, actual, 0.6%.
United States Import Price Index, MOM, came in at 0.3%, above forecasts, 0% in August. Canada Consumer Price Index, MOM, registered at 0.1% below expectations, 0% in August.
Yeah, so import prices are coming in as well, which can lead to perhaps a PCE increase. Sorry, I was scrolling through this and I forgot what I was looking for. Anyways. So, with that being said, we have a slowdown in the economy, but increasing inflationary pressures. Yeah. So, what I said, I don't know, 5 years ago, when COVID hit, I said two things are likely to happen: big changes, okay, in economics for the United States. And in fact, I think it was the very first week on the street. No, was it week on the street? No, off the charts with Wayne McDonald. So you have to go all the way back to COVID. So I started a thing where I sat outside, I read a newspaper, I drank a scotch, I smoked a cigar, and I read economic reports, and like we were just hanging out shooting the shot as traders and investors. And I said, and we talked about 10% unemployment and 12% inflation. And I said, well, look, there's a consequence because all of this is coming from our response to COVID. Now, I'm not saying it was the right thing or the wrong thing. It's just, it is what it is. It happened. And when you increase money supply, I mean, read some Milton Friedman. It's very basic stuff. Inflation is totally impossible unless you increase the money supply, assuming you have a functioning economy. Like if there's scarcity of everything, you got another problem. But the easiest way to create inflation is just simply to jack up the money supply, which we did. Now, the Fed takes a lot of blame because the Fed put in $5 trillion, but the cool thing about increasing the money supply that way is that you can manipulate the money supply through Fed tools later on and take it all back. The Fed can create money, we'll say, and the Fed could destroy money. Well, that was $5 trillion. 500% more than the great financial crisis. That's a lot of money. But the Fed is already winding that down, and I believe they've already taken $2 trillion of the $5 trillion that they've added through the balance sheet reduction. Okay, great. Well, the federal government also gave away free money. That is straight up inflationary. Because think about it, an increase in let's say wealth is investing money and getting a return on investment. That's not necessarily inflationary. When you simply pump money in and get no return on investment, that is inflationary. And that 5 trillion is still in the market, right? So what I said way back then, 5 years ago, is that the consequence of all of this is we'll probably have a higher level of unemployment when we use the term full employment. So at that, before that, we were at like 3.4% unemployment, and we called that full employment. I think full employment now is probably somewhere between 4 and 5, not 3.5, 4.5, but more like, I don't know, 4.5 to 5. That's a huge shift. If you're managing an economy, you have to base it on what you think is normal. So if you're shifting, let's say, breaking Bank of Canada,
core CPI surprised to the downside in August. United States Import Price Index, year over year, climbed from previous 0.2% to 0% in August.
So, all right. So it's a huge shift in just mindset, is what I'm saying. If 4.8% unemployment is considered good. Well, we're not even there yet, but maybe we are on our way there. We're just maybe not measuring it correct. The second part of that is inflation. If the federal bank can reduce its balance sheet, but the federal government cannot, then the problem's not going to go away. And again, remember, this is what we were talking about 5 years ago. So here we are, we're at 2.8, 2.9% inflation in the United States. The Fed's cutting. Well, then what about that 2% inflation target that Ben Bernanke introduced? So when I first started trading Forex, inflation targeting was new, and central banks never admitted they had a target. They might have had one, but they never admitted it. In fact, it goes so far back when Ben Bernanke was nominated to become the head of the Board of Governors. I said, Ben Bernanke? Who's this guy? Some Princeton a-hole. So I bought his textbook, and I bought his book on the Great Depression. So it turns out his expertise is inflation targeting and the Great Depression. So guess what? He was thrown into a Great Depression and really brought inflation targeting to the forefront, in which the central bank, and they all do this now, say, well, we're targeting 2% and we're going to use our monetary policy to get us to 2%. I think the Fed has acknowledged, at least for let's say the next 5 to 10 years, they're like, dude, there's no way in hell we're going to get back to 2%. Like, mathematically impossible, especially if we have an extra $5 trillion in government money still floating around the money supply. There's just no way to get it back. So it's interesting if the Fed has finally capitulated behind the scenes and said, you know what? Our target is 3, not 2. They haven't admitted it, and I don't think they will admit it. But I think they'll just say, well, inflation's going to be at 3 forever, and unemployment is rising. And in particular, unemployment is a problem because, not unemployment, but job growth, we'll call it. It very, 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 very quickly can change. From everything is right to all of a sudden we're in trouble. And you've kind of seen that where we're printing 300, and now we can't even get 100. But part of this also is government policy where less immigrants are coming in and more immigrants are going out. So you can have people not getting jobs and the unemployment rate doesn't change because the workforce is shrinking as fast as job growth is shrinking. And so there's this other component to jobs in which the government thinks about, well, what's the break-even rate? How many jobs do we have to create every month to handle things like immigration and birth and death and all this kind of stuff, right? Because all these things impact the size of the labor force. And remember, the unemployment rate is tied to the size of the labor force. So 100,000 people could lose their job, but the labor force could drop by 100,000, so nothing changed. But 100,000 people lost their jobs. And so anyways, that break even, I think traditionally, and I don't know, I'm going from the top of my head, we'd have to Google it, but I think it's considered to be like 150,000 jobs a month. So NFP needs to be 150K just to break even. I think that's dropped by 66%, is my guess. Whoa. So now our break even is 50K? So we're at break even, really. unemployment eventually will go higher. Inflation is going to be around 3%. That's a whole different world than we lived in a year ago. I have a feeling all this stuff is starting to add up. So we've had miserable NFPs relative to what was expected and huge revisions. Unemployment hasn't changed. And retail sales hasn't changed. Hmm. Sky Killer's right. That would be inflationary. Yep. And so that's just a consequence. I think maybe central bankers, in particular the Fed, have looked at all these different sort of changes
U.S.
in
import prices
policy.
unexpectedly rise 0.3% in August.
U.S. retail sales climb much more than expected in August.
So the economy measured through jobs is slowing down. There's no doubt. Really, I think the answer is it's been overstated. The BLS has screwed up. I hope you fully appreciate that. Yeah. And have been for years. And so, right? And so now I think the Fed is saying, okay, oh my God, we've been data dependent, but the data's been wrong. How do you think that feels? I think psychologically, at the FOMC level, it's huge. Huge. They're like, okay, we trust you, Jay Powell, will be data dependent. But in my district, it feels different from what the data shows. Kind of like when the government was telling you inflation was fixed, and then you go to the grocery store and everything's expensive, and then you want to buy a house and it's expensive. You want to buy a car and it's expensive. You want to buy some clothes and it's expensive. And you're like, what the heck? I thought this was fixed. And it didn't feel like it to you. You're like, okay, well, they're telling me everything's cool, but it doesn't seem cool when I go shopping. And remember that retail sales is not inflation adjusted. It's seasonally adjusted, but not inflation adjusted. So maybe you're just paying more, right? I mean, think about it this way. If retail sales simply measures how much money you spent at the gas station every time you fill up your car, which it does, they'll say, oh my God, look, retail sales is up. Well, you're like, no, retail sales isn't up. The cost of gasoline is up. That's a CPI issue. And they're like, no. Well, we measured all the receipts. You're like, well, why don't you just measure how many gallons of gasoline was purchased? So, for example, if gasoline prices went up 30%, but people started putting 30% less fuel in their gas tank because they always just put $20, right? They're like, right? They're just like, put $20 on pump number 2. Well, what if, so $20, so nothing's changed. You're always putting in $20. But what if it gets you 2 gallons less than it used to? Well, retail sales is stable. So, the government could just track how much gasoline is sold. But nobody wants the truth, right? So anyways, all these measures are in flux. And I think the Fed is saying, oh my God, we've been data dependent and it didn't feel right, but the numbers were there. But, so if you were the president of the Fed in Detroit or St. Louis or Atlanta, okay, these are all different Fed presidents, and they all have their own databases, and they're all gathering their own data from their own data set. We call that the Beige Book. And they're like, it's not like that in Atlanta, but I guess it's like that everywhere else. And Jay Powell says, we're data dependent, and we're using data from from all our different government agencies. And one of the most important things is the Bureau of Labor Statistics and the job report. And then you find out they could be off millions. Well, shoot, they might have made different decisions. You see, we might have cut back in June. So now everything's in play, you see. So that's why I think tomorrow is going to be interesting, because I think the Fed has capitulated, and I think Jay Powell's had private meetings with everybody individually, and they're like, look, Jay, you kind of screwed me over here. We're data dependent. In my district, I felt like we should be cutting, and yet, we've had our FOMC conversations, and you've kind of twisted my arm to vote unanimously with your guidance that everything's cool. Look at the BLS NFP. And now we find out all of that was quite wrong. I'm like, aha. So now Jay Powell has to say, we might have been wrong. Well, he's not going to say that. But how about this? What if, and particularly the new person in charge of the Fed next year, says, hey, President Trump, because remember, if you're going to be on the board of governors, and the chairperson of the board of governors is nominated by the president, as well as the other board governors, not the presidents, the governors specifically, what I'm talking about. So Jay Powell's replacement.
Oil and gas field output accelerating, IEA says. Russia close to cutting oil output due to drone attacks. Report. Oil prices rise as market weighs Russia supply risk, U.S. rate decision.
So what I'm getting at is the new person in charge of the FOMC is going to go to the president and say, you know what, this, Mr. President, if you put me in charge, I'm not going to be data dependent, because that's looking backwards. And, Mr. President, some of the data is volatile, lagging. Use whatever descriptive word you want. I am going to be forward looking. I'm not saying this is better, but I'm saying this is how to become chairperson of the FOMC and the board of governors, right? Because you have to be nominated by the president of the United States, and then what do you call it? Vetted or voted on or approved by the Senate. I guess approved. And so I think this is how it's all going to go down. High unemployment, high inflation, the Fed looking forward more than data dependence. And so it's going to be an interesting ride the next few years as an institution, we figure all this out. Yeah. And the Fed is already changing their framework, which reminds me, today at noon at investorbootcamp.com, we are doing the next watch party. And yes, they are recorded. Remember, the fee is whatever you want to pay. That's a pretty good negotiation tactic on my part, huh? Pay whatever you want to pay. But we're in this area here. Yeah. Cool. That's at noon today. Okay. The other way to access this Just go to investorbootcamp.com. Log in. And it's right here. Cool. And so you'll get an email inviting you to the event. That's how it works. Yeah. Cool. Cool, right? Yeah, so we'll do that live together. And when I do these watch parties, I pause the video a lot and give you insight and historical context. So you get sort of a deeper meaning than just the pure, I don't know, let's say mathematics. I stop things and I say, oh, well, this is what the context of this comment was, or this is what we did, and now we know the consequences of that, which in the video we didn't use it, right? And then where it's leading us in the future. So I'm enjoying the project. I hope you are too. So that's at noon. Tomorrow, if you go to youtube.com/Forex.Today, there's us now, and here's tomorrow.
Hi, currency trader.
So turn your notification on. Oh, thumbs up wouldn't hurt. And that's tomorrow. So I'll start it at 1:30. I'll set the table. Okay. For the event, I can answer your questions. We'll get the news when it comes out at 2. And we'll see the cray in the market after the news. And then a half an hour after that, there will be a press conference, and we will watch that together. Press conference together.
Pi Network Price Forecast. Bulls under pressure as PI retests a falling channel breakout. United States Redbook Index, year over year, fell from previous 6.6% to 6.3% in September 12th.
Eurozone industrial production recovers in July.
U.S. stocks may lack direction as meeting gets underway.
Yeah, so the Fed meeting technically just started. Yeah, it's a 2-day meeting. And yes, that is covered in our training courses at Investor Bootcamp. Mm-hmm. Cool. And just one final thing. If you like pretty colors, we have some new pretty colors. We've updated our options coverage. Instead of just doing the generic full put-call ratio of all 1 million options contracts, we broke them down to ETF subcomponents, if you will, and the options traded on things like SPX. Okay, SPX is an ETF that follows the S&P 500. And what we're measuring here on SPX is the option positioning. Okay, and right now, and you can see this is a trend that's been going on for a week or so. This move here shows that there's more puts in the market than calls, which shows you measuring everybody that is exposed to the S&P 500, is most of them are using options contracts, aka puts, to hedge their cash position in the S&P 500 or S&P 500 stocks. So we're going into FOMC, the week of FOMC, so going all the way back to Monday, the market has been hedged, already hedged. Now, the learning point here is institutional investors don't seem to be like degenerate gamblers. So they see tomorrow's news, even though it's almost certain. They're like, yeah, well, if it collapses, I don't want to lose a bunch of money on my cash position. So if it collapses, I'm going to make some money on the downside in the options market, which offsets the losses that I take in my cash market. Plus the options leverage 40 to 1. So for every dollar of option exposure to the downside, you get $40 of protection to the cash position to the upside. Aha! But we can do that now for things like gold, dollar index, NASDAQ. Okay? Oops, gold. Pixie. NASDAQ. Okay? Look at NASDAQ. Yeah, hedging like cray-cray.